your portfolio is flashing red. The market is falling, and the value of your stocks is dropping. It feels like a free fall. But what if one part of your portfolio wasn't? What if it was holding steady, providing a calm in the storm? In our last episode, we explored the exciting world of stocks. We learned that buying a stock is buying a piece of a business, a share of its future growth. It's the powerful engine of your investment portfolio. But let's be honest. That engine can be volatile. The ride can feel like a roller coaster. And for many people, the fear of the inevitable drops, the gut-wrenching market corrections, is so strong that they never get on the ride at all. They stay on the sidelines, missing out on decades of potential growth. This is a huge problem. Because what if there was a way to have the growth without all the whiplash? Consider the story of two investors, Ethan and Olivia. They both start investing in their early 30s with the same goal: build long-term wealth. Ethan, excited by the potential for big returns, puts 100% of his money into a diversified portfolio of stocks, just like the ETFs we covered in episode 5. He feels bold and smart. Olivia invests in a similar mix of stocks. But she does one thing differently. She allocates a portion of her portfolio to something else. Something less exciting. For a few years, the stock market soars. Ethan's portfolio grows faster than Olivia's. He gently teases her about her slow and steady approach. Then, the inevitable happens. The market hits a rough patch and drops 20% in a matter of weeks. Ethan is in a full-blown panic. The value of his account plummets. He feels a pit in his stomach every time he looks at it. He considers selling everything, just to stop the pain. Olivia isn't happy about the drop either, but her portfolio is only down about 12%. A significant portion of her money seems almost untouched by the chaos. While Ethan is panicking, Olivia is calm. Her long-term plan is intact. She hasn't made a mistake. She has a financial anchor. Ethan didn't. That anchor has a name. It's called a bond. And this is the revelation that will change how you think about building a truly resilient portfolio. We learned in episode 10 that a stock makes you an owner. A bond makes you a lender. When you buy a bond, you are not buying a piece of the company. You are loaning money to that company, or even to a government. In return for your loan, they make a simple, legally binding promise. They will pay you back in full on a specific date in the future, and along the way, they will pay you regular, fixed interest payments. It is one of the most stable and predictable investments in the world. Let's use an analogy. Buying a stock is like owning a piece of a champion racehorse. The potential for glory and massive winnings is huge. But it's also risky. The horse could have a bad season or get injured. The outcome is uncertain. A bond, on the other hand, is like owning the mortgage on the stable where all the horses live. It doesn't matter which horse wins the race. It doesn't matter if it's a good season or a bad one. The owner of the stable still has to pay you that mortgage payment on time every single month. The potential reward isn't as explosive as owning the winning horse, but the income is incredibly reliable. There are 3 key parts to a bond. First is the principal or face value. This is the amount of your loan that will be returned to you. Second is the maturity date. This is the day your loan is due, and you get your principal back. And third is the coupon. This is the interest rate the bond pays you for lending them your money. There are 2 main types of bonds you'll encounter. The first are government bonds. When you buy one of these, you are lending money to a country. In the United States, these are called Treasury bonds, and they are considered one of the safest investments on earth. The risk of the US government failing to pay its debts is incredibly low. The second type are corporate bonds. This is when you lend money to a large company. These are a bit riskier than government bonds. A company, even a big one, could go bankrupt. Because you're taking on more risk, these bonds almost always offer a higher interest rate, a higher coupon, to reward you for it. This is where the true power of bonds comes into play. It goes back to the core lesson of episode 3, diversification. Stocks and bonds are the ultimate power couple. They have what's called an inverse correlation. They often move in opposite directions. When the economy is booming, stocks tend to do very well. But when fear grips the market, Investors often sell their risky stocks and rush to the safety of bonds. This is what happened with Ethan and Olivia. As stocks fell, the value of Olivia's bonds held steady, acting as a powerful stabilizer for her entire portfolio. So, how much should you have in bonds versus stocks? There's no single perfect answer. It depends on your age and your tolerance for risk. A common rule of thumb is to subtract your age from 110. The result is the percentage you might consider keeping in stocks. So a 30-year-old might have 80% in stocks and 20% in bonds. A 60-year-old, closer to retirement and needing more stability, might have 50% in stocks and 50% in bonds. This is just a guide, but it illustrates the principle. As you get older, you gradually want to own less of the volatile racehorse, and more of the reliable stable mortgage. This knowledge is empowering. It shows you that building a portfolio isn't about being an adrenaline junkie. It's about being an architect. You are building an all-weather machine, with an engine for growth and an anchor for stability. Bonds are the counterbalance that allows you to stay invested through good times and bad, letting the power of compound interest, which we learned about in our very first episode, work its magic over the long term. You don't have to fear the storm, if you've built your ship to withstand it. This balance between growth and stability is the heart of a mature investment strategy. It's the shift from simply seeking returns, to building true, lasting wealth. And building that wealth is a journey made stronger by the insights we construct together. Our mission is to tackle the financial questions you're actually asking. Let us know in the comments what practical challenges you're facing, and your idea could shape a future episode. Subscribe and join the conversation.